Hi all, thank you for joining us. This is our webinar today with Lucy Cohen, co-founder of Mazuma, and we'll be talking all about tax returns with the deadline coming up at the end of January. Lucy will discuss how to submit your tax return, what you should include and how to get registered. She'll run through how to get your records in order and planning your budget. There will be an opportunity for any questions that you do have. You can pop them in the Q&A function at the bottom of your screen and we'll do our best to answer these towards the end of the session. The session is also being recorded today, so we will send out a follow-up email to all registered attendees after the session with an on-demand version of the video. So if you need to catch up on anything or if you miss it at all, it will be available for you later on this afternoon. And with that, I'll pass over to Lucy.
Hello, good morning, everybody. It's always a bit weird speaking into the void. And as those of you who follow me on social media will also notice, I'm currently presenting from my my in-laws' garden shed office whilst we have work done in our house. So it's a little bit of a 70s sauna vibe, but that's good. We can work with that. That's cool. Maybe we'll cover home office expenses later on when we go through the presentation. So I'm going to give you a little bit of an introduction as to who I am, why I'm qualified to talk to you about this. And then Chloe's going to pick up questions from you later on. Please do ask questions, or if you're watching this on catch up, feel free to reach out to me on socials and ask questions or get in touch with my team. We'd be really happy to help you. Okay, so a little bit about me then. My name is Lucy Cohen. I am the co-founder of Mazuma. I've been in the industry, well, it's a little bit out of date now, nearly 19 years, which makes me feel very old. And I am a small and micro business expert. And my company, my firm is Mazuma Money. We were the UK's first ever subscription-based accountancy service back in 2006. This was pre the days of cloud software, pre the internet being anything other than or your website being anything other than just a brochure for your firm. We have thousands of clients across the UK, and like I said, we're micro business specialists. So we deal with small business and micro businesses, so startups, owner managed businesses, sole proprietors, really anything up to about 10 staff is our speciality. We're a combination of technology and people, so we don't force people down the route of having to use tech if they're not comfortable with it. I know a lot of you have very physical businesses and like to touch and hold things and don't love doing everything in the virtual world. That's cool. But also, if you do love the virtual world, we've developed our own technology to make your life super easy. We deal with sole traders, limited companies, partnerships, and LLPs, and we are multi-award winning. So a bit of a badge of honor there for us is that hopefully we know what we're doing. So today, we are talking about self-assessment tax returns. It's that dreaded time of year where everybody with the good intentions of getting things done before now starts freaking out, and that deadline is looming. Although this year, because of COVID, same as last year, they have pushed the deadline actually to the end of February. However, don't just sit on your laurels and think that you've got till the end of February to do it. Get it done now. I can guarantee you, if you're using accountants, they don't love you for coming in after January. We very much plan our January out, and Hmrc gave the announcement of the deferral of the deadline actually in January. So it wasn't much help for us because we've already planned our workload. So please do, if you're going to use an accountant, get it done. Or if you're doing it yourself, get it done quickly, because if you've got a rebate due, you'll get that cash faster than you would otherwise. They're taking around a week at the moment to process refunds, as long as you do it electronically. So yeah, not bad at all, especially if you're feeling a little bit cash strapped after Christmas. So what the blooming heck are self-assessment tax returns? They are essentially Hmrc's system to collect income tax, and the income tax year, for reasons that I won't bore you with, runs from the 6th of April to the 5th of April every year. And after that 5th of April, so 5th of April 2021. So I'm always in like 3 tax years. I can never remember what year it is. 5th of April 2021. You've got until the 31st of January, usually 2022, as in this January, to file your tax return and pay your tax. So you have to both file your return and pay any tax due by the 31st of the January the following year. And that's how it's been since the modern tax system, I think, has been in place since around 1994, when the modern we call the modern self-assessment came in. Prior to that, it used to be called something called Schedule D, but most people here have probably been operating or at least born before 1994, or are not old enough to remember the old tax system. Give me a heads up if you do remember it. It's a long distant memory now. So who has to do a tax return? It's not just people who are self-employed. Obviously, if you are self-employed, you will need to do a tax return. So you might talk about yourself as a sole proprietor, a sole trader. If you've earned more than £1,000 before taking off anything that you can claim tax relief on, you have to do a tax return. Maybe you're a partnership in a business, so you might be a partner in a traditional partnership. And with a traditional partnership, what happens is the partnership does a set of accounts, and then the profit is split between the partners, 50-50, 60-40, 33-33, 33, 20-20-20-20 is a 5 view, depending on what your profit share in the business is. And then you declare your profit from your partnership on your tax return. Maybe you've got a full-time job and you just happen to be a landlord or an accidental landlord, like my husband is. He met me and we bought a house together, and then he's rented out his old flat. So he has to do a tax return because he kept the flat and rented it out instead of selling it. And that means that rental income has to be declared. So even something small like that means you'll have to do a tax return every year. Perhaps you earn tips and commissions from a job that you do that aren't taxed at source. So the key here is being taxed at source. As long as it's not taxed at source, you should probably put it on a tax return. Maybe you've got income from savings, investments, dividends. If you're an avid investor in other companies, and you can buy shares of them, and you get a little dividend statement every year. If you're doing well at that, you might have to declare quite a lot on a tax return. There's a discussion going forward with the tax authorities about when crypto is going to start becoming potentially taxable. It's taxable in the USA at the moment, so usually we sort of follow suit with that kind of thing. And then maybe you've got foreign income. So foreign income might be one of two things. You might have foreign income in a country where we don't have something called a double taxation treaty. So in a lot of countries that British citizens typically do a lot of trade with, we have something called a double taxation treaty, which means you only pay tax on it in one country. You don't end up paying tax on it when you bring it into the other country, because we've got this taxation, I think it's 1978, we've got this taxation treaty that's been in place. Some countries have it. Even if you're not paying tax on it again, you still have to put it on your tax return. Just let HMRC know. You won't pay any tax on it. You just say, I earned this money in, I know, America, France, Canada, wherever it's going to be. I don't have to pay tax on it, but here it is, FYI. Or where you're earning money from a country that doesn't have a double taxation treaty, and therefore you have to put it on your tax return and you have to pay tax on it. So those are some reasons you'll need to be doing a tax return. Other reasons you might want to do a tax return, you might choose to do a tax return. And that might be if you want to claim some income tax reliefs. This slide deck has actually got links in it, and if it's all right, I'm not checked this with Chloe, but I'm very happy for people to have a copy of this so that you can see the links here. And that will give you the links there to some of the income tax reliefs, which means you might want to claim tax on. Typically things like maybe you've made an investment under EIS or SEIS, you can claim that and you'll get tax relief on that on your tax return. Or maybe it's because you want to prove that you're self-employed. So you want to claim tax-free childcare or maternity allowance, which, if you think about it, if you're an employee of a company, your employer takes care of all that tax stuff for you. You don't have to think about how you're going to go about proving that. If you're self-employed, like everything else, it's a little bit harder. You have to go about proving that, and you might want to do that by filling out a tax return. So if you need to do a tax return or think you need to do a tax return, your job number one is you need to get registered. And you need to register if you didn't send a tax return the previous year and your circumstances have changed. So typically the year that you become self-employed, get yourself registered with HMRC. You don't have to register every year. That's a common misconception, that you have to tell them every year. Basically what happens is you will tell HMRC via one of these links, depending on whether you're self-employed, a sole trader, not self-employed, or a partnership, a partner in a partnership. You don't have to tell them every year. They will assume you need to continue doing a tax return ad infinitum as long as you are registered. There are a couple circumstances where they might decide you no longer need to do a tax return of their own volition. noted there, if they tell you that, but you think you still need to do a tax return, you can't just go, oh, well, HMRC said I don't have to do one anymore. The onus is on you as a taxpayer to make sure that your tax affairs are in order. Even if HMRC get it wrong and they say you don't need to do a tax return anymore and you're still quite obviously self-employed, you need to go, no, I do. I'm going to do a tax return. Please keep me registered. The only instances where really might not is you've retired and you just got pension income that's taxed at source, and so they don't need that from you anymore. Or perhaps you're a director of a limited company and you're not taking any dividends or having any P11D benefits or anything like that. You're just on a standard salary, and they decide after a couple of years, and it usually is a couple of years, they decide after a couple of years, all right, okay, we don't need to get a tax return from you anymore. We know what you're doing. That's fine. But like I said, the onus is on you. So you need to get registered with HMRC. And if you've become self-employed and it's your first time being self-employed, the rules are you need to have registered with HMRC within 12 weeks of having received your first income from your self-employment. That's the official line. I would recommend register ASAP. As soon as you know you're going to be self-employed, register. Why? Well, in your first year, very few people quit employment on the 5th of April and start self-employment on the 6th of April, and there's no crossover. Quite a lot of people will go from employment partway through the tax year, go to self-employment, and it's not unusual within your first year of being self-employed to not make a profit, to make a loss. If you've paid tax on your income and you make a loss against your self-employment, you can offset that loss against your tax income, and that might result in a tax rebate for you. When you first start a business, you first start going self-employed, that is a godsend, because as we all know, running a business, cash can be really tight, and it's nice to have that tax back. Absolutely fine. Obviously, if you've made a loss, that's actually reduced your total amount of income. So therefore, because you've essentially self-funded it out of your previous job, therefore your overall income has reduced. So you've accidentally paid too much tax on your employment income, and that's kind of how that gets worked out. So yeah, that's something that I would recommend doing, and to register as soon as possible. Firstly, because you get used to it then. It's not a gigantic shock when you end up having to do it. So doing the tax return, this is the biggie, isn't it? All well and good getting registered, all well and good being self-employed, but you get a load of scary letters from HMRC and they ask you to do a tax return, and then you think, crikey, how am I going to do this? So here is my advice, if you're tackling this yourself, of how to get your tax return done. So first of all, before you leap into the HMRC site, collect everything you need. Get your documents together, get yourself organised, get it all in one place. Documents you need is going to be things like P60s, P45s, bank interest summaries, maybe your P60 from your pension income, maybe details of your rental income, your self-employed income, and anything else that you think you might need there. So weird letters you've had from HMRC during the year, strange taxable things, details of all your receipts and expenses. Now, depending on the sort of person you are, you might be a physical person and you might work in a physical world. My sister, for example, is an artist. She goes to physical art supply shops. A lot of what she does results in bits of like literal bits of paper. She doesn't love the idea of taking photos of everything and keeping it all electronically. So she just has a classic box folder in one place on your desk, on her workstation. Every time she gets a receipt, she just shoves it in there, and that's absolutely fine. And she keeps a track of all her income on a little spreadsheet. That means that she knows everything is in one place. Any letter she receives from HMRC, into the box. Anything she thinks is vaguely tax related, into the box. That is my top tip. It sounds so simple, but so many people don't do it. At the end of the day, when you come home and you've got pockets full of receipts, things, just sort through them. Anything that's not tax related, in the recycling. Everything else, into your box folder. If you're a digital person, you might want to use something like Dropbox or Google Drive or something. Create a folder per tax year and store everything in that. It doesn't have to be particularly organized in there. You're just putting it into a central repository so that you've got this information, and so that you're not getting to the end of the tax year and feeling completely overwhelmed with, oh, where have I saved that? And I'm sure that was on an email and I can't find the blooming email. Keep it all in one place and doing it little bit at a time makes it way more bearable than having to do it all in one go. And then, of course, what you want to do is also keep your receipts and things that you spent money on as a business. Now, this is the biggie here, really, tax deductible. What is and isn't tax deductible is the big question on everyone's lips. It's the most common question that accountants get asked. And I'm going to give you a bit of a rundown, I suppose, of what is and isn't tax deductible. Like I said, this is probably the space where you might have questions. Feel free to pop them in chat here, and we'll pick them up later on. Okay, so the rules here, and the one to remember, the one that is the kicker here is use, when you're deciding what is and isn't tax deductible, use the wholly and exclusively rule. What does that mean? We deal with, at Mazuma, a lot of people who work in the film and TV industry because they're all self-employed. They often ask us, well, I work in the film and TV industry. Can I claim my TV license as a tax deductible expense? No, never, absolutely not. And here's why. It is entirely likely that without you working in film and TV, you would have a television license. You probably have a TV license. Unless you were able to prove that you only got a TV license because you worked in film and TV. And that might include proving that prior to working in film and TV, you didn't have a TV license. You're not going to be able to claim that as a tax deductible expense because it's not wholly and exclusively for use in your business. It's got something that we call duality of purpose. So yeah, all right, you might use your TV more because you work in film and TV, you have to do research or whatever, but you'd have already been paying that regardless. So therefore, you don't get to use any of it. You can't claim any of that. It's not wholly and exclusively for use in the business. You can't even apportion a little bit of that. So here's kind of the most common things which we can look to apply the wholly and exclusively rule to. So office costs. So I said I'd touch on this later, didn't I? That was a nice segue. Seamless, this. Office costs, stationery, pens, papers, printers, ink cartridges, photocopiers, anything you look around you and you see in a standard office and you're using it in your business. So not your kids' school supplies, but things you are using in your business. And that can be a myriad of things. I've done presentations in the past where I've bought felt tip pens and I bought bits of tinsel to stick on things. I'm quite old school. I love a physical display. Yeah, those are, I'm using them wholly and exclusively for the use of my business. Absolutely, I can claim those, not a problem. Even down to phone bills. So mobile phone bills, you can, it's quite reasonable to say, well, I use my phone 50% for business. So therefore I picked a subscription, I picked a plan that was appropriate for that. So I can claim 50% of it. That's absolutely fine. And the reason that's fine, whereas the TV license one wasn't, is you realistically are using more of your phone, which incurs more costs, or you've picked a different plan, which is maybe more expensive than a standard domestic plan or a family plan or something like that. So yeah, phone bills, maybe you put a second line in to your home office for broadband. Maybe I bought a mobile dongle when COVID happened because our internet in our house is it's got big thick walls, terrible upstairs. Yeah, so I bought a dongle so I could have reliable internet through COVID. That's absolutely fine as well. Travel cost. So parking for business purposes, train travel, coach travel, air travel. Well, those are the days. Remember going on an airplane? Fuel costs. Now, fuel costs. I don't love fuel costs unless you have a vehicle, a van that only ever does business mileage. So maybe it's a van that you drive to a construction site, and that's what it does. It's got tools in it, and you don't use it for kind of going, any domestic purposes. I don't love fuel costs, and here's why. They're hard to prove. How do you prove how much of each fuel bill you ended up using for business purposes? I prefer mileage. It's much easier to track. You can get mileage trackers on your phone that do it for you. If you've got a fancy car, it's probably got a journey tracker in there. You can do that. It's quite easy with mileage to prove, well, I made this journey and that was a business journey and it was from this postcode to this postcode, and therefore I'm claiming 25 miles at 45p a mile. You can claim 45 pence a mile for your first 10,000 business miles and then 25p a mile thereafter. You can also claim, I think it's 25p for riding a pedal bike to business. Now, That's completely improvable. It is 25p a mile. So if you're into your cycling and you're using your cycle to get to business meetings, crack on, you can claim that. One thing you can't claim with travel is the cost of normal commuting. So again, if you think about if you were an employee of somebody else, you would just have to suck up your travel costs. It's part of one of the things you decide on when you take a job is what are my travel costs going to be? What's my commute time going to be? You can't claim normal commuting. Now, a lot of us nowadays are just commuting from downstairs to upstairs, or at the moment I'm commuting from the main house into the garden. I suppose you could ride your bike down there, but yeah, you wouldn't be allowed to. Clothing expenses. I had a conversation with a chap recently who was absolutely gutted that he couldn't claim the cost of his fancy suit. So he was setting up an agency, a very high class profile agency, had to attend some very important meetings, bought a very, very fancy suit, lovely suit, and wanted to put it through his accounts. And he was devastated when we told him that you couldn't do that. And the reason you can't do that is you'd have to wear clothes anyway. Doesn't matter how expensive those clothes are. It doesn't matter how fancy those clothes are. It's unlikely you'd turn up to a business meeting naked. So there is an expectation that you would clothe yourself in some way, shape or form. Therefore, normal clothing is not an allowable expense. Safety clothing is, so like steel cap boots, safety wear, maybe if you're out on a building site and you have to wear special protective or insulated clothing to protect you from cold. That is all absolutely allowable. Anything with a permanent logo embroidered on it or printed onto it. So not a jacket that you put a pin badge on. You could claim the cost of making the pin badge, but anything with a permanent logo on, which is classed as uniform, that is allowable. Also, if you're having to wear things specific to your industry, like if you're a therapist and you have to wear certain hygienic clothing or PPE, things like that are obviously all allowable. Staff costs. So the cost of any staff you have, that can be staff who you've got on payroll, on PAYE, or that can be subcontractors who are also self-employed themselves and you're using them within your business. They're allowable. Obviously, things you buy to sell on, if you've got a shop, the cost of stock and the shipping of that stock is an allowable expense. Financial costs, interest, bank charges, loan arrangement fees, things like that are allowable. The cost of your business premises, so business lighting, heating, business rates. If you're working from home, you can claim something called use of home as an office. You can claim there's a standard, I think it's £4 a week is the standard fixed. You haven't got to work it out or prove it to HMRC. You can claim £4 a week for that, which is £208 a year. Or you can work it out yourself as long as the way you work it out is reasonable. So again, if people are interested, I've got a calculator which we use for that, which HMRC accept. I'm very happy to share that later on. Training courses. So the cost of improving your skills as a self-employed person, absolutely allowable. The cost of retraining to do something else is not allowable. So let's say you were self-employed being a business consultant and you want to completely retrain to be a self-employed hairdresser. The cost of retraining to be a hairdresser is not allowable, but the cost of doing, maybe a management course or a sales course to improve your skills as the original business consultant would be allowable. Capital allowances. In accountancy, we account for things when they relate to, not when they're paid. Usually that's the accounting accruals concept. Very small businesses can use cash accounting, but typically you use something called the accruals concept. Capital allowances, if you think you buy a big bit of machinery, that might last you for 10 years, 5 years. You wouldn't put all of that in your profit and loss account in one go because it's going to make it look like you've made a loss and you might not have. And as we know, if any of you are self-employed and want to apply for a mortgage, you don't want your income to be too low because if it looks like you're making a loss year on year, you won't be able to get a mortgage or even a rental property as a reference. So capital allowances, large purchases, we would claim those all in one go on the balance sheet and drip feed them in over 5 years. The tax system encourages spend on plant and machinery. So you get something called an annual investment allowance, which allows you to claim off your tax all in one go, but not have to reflect that in your accounts, which is great. So if you're getting to the end of your tax year and you're thinking about making a big purchase anyway, just before the end of the tax year, if you've got the cash to do it, it's the perfect time to do it because you get that allowance for it. It's brilliant. And like I mentioned, use of home as an office. It's really important that you keep records of everything. You can't keep too many records. You can't be too diligent here. It's better that you have too much than too little. So you want records and details of your income, expenses, VAT, PAYE, what you've taken out of the business as drawings, any details of the COVID grants that might have been claimed over the last couple of years. Digital is preferable. Now, I mentioned, obviously, some people work in a physical world. Services like ours will digitize documents for you. Making Tax Digital comes in from 2024, which will take the tax return for most self-employed people who earn more than £10,000. You're going to go from having to do a tax return once a year to having to do it 5 times a year. So you're doing it quarterly and then a catch-up one at the end of the year. So this is why it's so important to get into good habits now. They don't have to be onerous habits, just keeping things in one place. And then finding, if you don't love making stuff digital yourself, finding a company like ours that will digitize it for you, because the requirement when making tax digital comes in from Hmrc is that you will have to keep things digitally. You've got to keep your records for at least 5 years after the 31st of January submission deadline of that tax year. So the 2021 tax year, that's the deadline is this January, you want to keep them 5 years from now. So in real life, we're talking 6 years that you want to keep things for. Again, very easy to do digitally, but we've had people who've, lost stuff in floods or damp, or literally the dog's eaten it, or it accidentally got burned in the fire pit at the bottom of the garden because someone didn't realize the box was full of receipts. It happens. It can be dealt with, but if you do get an investigation by Hmrc, it's so much easier if you've already got your information there and in one place. I can't stress that enough. So a little bit here then, talking about kind of being self-employed and tax returns and the stuff that goes around it. Obviously, we're talking here about tax and how you're going to pay it, but you want to have a budget. Tax is an inevitability. If you're making a profit, you will inevitably at some point have to pay a tax bill. You want to budget for it. There's 2 ways of budgeting when you're running a business. Top down, which is not my favorite way. I don't love a top down budget. Top down goes, I'm going to make this amount of money, so therefore I'm going to spend all of this. And you go, I'm going to make £100,000, so therefore I can spend £90,000. If you're very confident of your sales, great. But as we know, sales is the bit that can give the most uncertainty. Might not be the most sensible way to do it. I prefer a bottom-up budget, which is to look at all of the fixed costs of the business, look at what you want to draw out yourself as the owner of that business, and then figure that out month by month, and then go, okay, well, I need to make this amount of sales to cover it. And then you can look at variable costs that go with that number of sales and whether you're going to take more out of the business, or if you're doing well, how you're going to deal with that. And that then will allow you to plan for your tax bill, because you'll see what your profit is likely to be, and you'll be able to go, right, this is likely to be my tax bill, and you can plan that into your budget. The point of doing this kind of budgeting is to adjust as you go along. So if you've had 3 great months and you thought month 4 was going to be brilliant and month 4 ended up being terrible, don't just carry on as if month 4 was brilliant. You adjust, you go, right, month 4 was not as good as I thought it was. Let's dip that sales figure down. Oh, look, I'm having to eat into my savings here. That's going to have an impact. Will I have enough money for my tax bill? That's how you do it. Remember that there is a big difference between profit and cash. Something that crops up a lot for us is people who will say, I don't understand why I've got a tax bill. I haven't got any cash. I've got no money. How am I going to pay it? And the reason this comes about is earlier on I said how we account for things when they, in the period they relate to, not when they're paid. So you might, on the last day of your financial year, raise a huge invoice for, I know, £100,000. And that goes into your accounts for that year, because that's when it happened. It's for work that happened in that tax year. You put it in that tax year. You might not get paid that until the next tax year. So the money that you're receiving for that income goes into the next tax year. If that person pays you really late, you might not have the money to pay a tax bill or a VAT bill, because there's that timing difference between the two. Remember that this is why I say you want to get your tax return done early in the year. Don't wait till January to get your tax return done. You can do it ASAP after the 5th of April. As soon as the year ends, you can get it done. Get it done as soon as possible. You haven't got to pay your tax bill straight away. You just have to get the things submitted. Then you know exactly where you stand. You know exactly what you're going to expect. You know exactly what you're going to have to pay and when. It's a much better way of dealing with it. Leaving it till January just leaves you with this: I've got no cash. How have I made a profit? I've got no cash. What am I going to do? Because April 2021, I'm sure we can agree, feels like a very long time ago. And you're now paying tax related to April 2021 in January 2022. So yeah, it's a long time. Use your cash flow forecast to help you manage your business. The point of a cash flow forecast, people really overcomplicate this. The point of a cash flow forecast is you are trying to predict your bank balance at the end of a period. That's all you're doing. You're looking at what you think is coming in, what you know is going out, and trying to predict how much money you're going to have. And that means that if you've got a bit of a cash flow gap, you can make adjustments to spending. You can look at bridging debt, like a way to kind of plug that gap, perhaps with an overdraft or a loan if you need to, short-term borrowing, or maybe longer-term borrowing if that's appropriate. That's the point of the cash flow forecast. The point of the cash flow forecast is to predict your bank balance and do your budgeting to try and keep on top of cash. It's a cliche, cash is king or queen, whatever. It really is true. And the best thing is we've got technology nowadays that really helps us. So we've got so much technology that can hugely assist us in working out our tax. So working out your tax bill, if you use the Hmrc tax return system or an accountant, they're going to work out for you, but you might want to kind of keep on top of it over the year to see roughly how much tax you're going to have. If you're a bit of an Excel whiz, you could program that into your spreadsheets. But ultimately, your tax bill, you're going to be paying your tax and national insurance, which are based on your profits. Everyone has a tax-free personal allowance, that tax code. That's the thing governments talk about a lot in election time. Tax-free personal allowance is going up. When I started in business, it was about £3,000. Now it's like £12,500 tax-free every year. But there's a great tool, the Hmrc Ready Reckoner, brilliant little tool, lets you plug your information in and will kind of give you an estimation of what your tax bill is going to be. Really useful for you, really useful little tool. I'm just going to show you a little demonstration here of what a tax bill or tax calculation looks like. So you can see here at the top of this person's had £3,228 worth of income. You can see all the allowable expenses here, so cost of sales, other income, premises cost, legal, professional, other expenses. Takes their sorry, I'm reading that entirely wrongly. My camera was in the way. They've had £14,000 worth of other income, so they've had 14,846. There's a lesson there. Move your blinking camera so you read the right numbers. That's embarrassing. Yeah, £14,846 worth of income in total once they've taken it into account everything. Their net profit then is that, and you can see there they've had some self-employment income support grant schemes. So their total profit, taxable profit, is £19,516. On that, then we're going to work out your national insurance. First of all, so your national insurance, there are two different types of national insurance. You've got class 2 and class 4 national insurance. Class 2 national insurance, until very recently, was paid by direct debit every month. So you can see there 52 weeks at £3.05 a week. It used to be paid on a monthly direct debit, but they've now just put it on the end of the tax return, which kind of makes more sense, but people always forget about it. So the tax bill is always 158 quid more than they think it's going to be because they forget about class 2 NI. And then class 4 national insurance, which is based on your profit again. So people quite often talk about the tax rate and the tax-free allowance. The national insurance free allowance is much lower than the tax rate. You can see the lower limit is 9,500, whereas the tax-free limit is 12,500. So you're paying national insurance on an extra £3,000 worth of income. And again, people forget about that. You can think about tax being 20% if you're a basic rate taxpayer. Well, £19,500 net profit, that class 4 NI charge, that's almost £1,000, over £900 additional to pay there, which isn't tax, that's national insurance. People always forget about it. So that's another one that catches people out when they come to do their tax returns. And then your income tax here, we can see how this is calculated. So you've got your trading profit, personal allowance there, like I said, that 12,500. Basic rate taxpayer here because the income is below £37,500 for this tax year. Take the national insurance off, and we'll end up here with your tax and national insurance total bill due to Hmrc. Here's the other thing that everyone always forgets about: payments on account. So let's imagine you went self-employed on the 6th of April 2020. Previously, you were employed by somebody. You used to pay your tax and your payslip like everybody else. Now you're self-employed and you're going through those first year struggles, and it's hard and it's challenging. You go from the 6th of April 2020 all the way through to the 5th of April 2021. You've not thought about tax really, unless there's someone like me nagging you about it. You've gone a whole year without paying any tax. And in fact, you're going to go a further 9 months without paying any tax again, because you don't have to pay any tax on that first year until January 2022. So you went self-employed on the 6th of April 2020, and you're not paying any tax until the 31st of January 2022. That's a long time. However, as we know, time flies by and everyone forgets that. If you've got over £1,000 worth of tax payable, you will have to make payments on account. So yeah, you may not have paid tax for over 18 months, but you're going to have to pay 18 months of tax in one go when you submit your tax return. So that's why I advocate submitting early, because you'll know this before January, so you don't have to, you might have budgeted for your tax bill, but I can guarantee you've forgotten about the payment on account. As you can see here, that person's tax due on that year was roughly £2,500, but they're going to be asked to pay 50% of that on top of that, taking that bill to over £3,500. That's a lot of money. And then they're going to be asked to pay the second half of that payment on account in July. So when you become self-employed, you're in this constant cycle of paying tax in January and July, January and July. Now, if you earn exactly the same every single year, your tax bill will be roughly the same in January and July. But if you earn less or more per year, those payments and accounts get adjusted up and down. So you have great uncertainty about how much tax you're paying and when. This is why it's so important to be on top of these budgets I mentioned. There's bottom-up budgeting, thinking about, right, my tax bill last year with this, I think I'm going to do 20% more. I'm going to have to allow for a little bit more tax. And honestly, one of the best rules you can make: every single pound you earn, put 30 pence of it away. It might seem like overkill. 30%, every £30 out of every 100 that comes into your bank account, you put in a savings account. It might feel like overkill, but by the time you've remembered national insurance and payments on account, you're going to end up needing that money to pay tax bills. So if you can get into that habit straight away or as soon as possible, it will really make your life a lot easier. So in order to submit the tax return, you can use the Hmrc system. Very easy. It's nice, easy. It just kind of walks you through it. You do have to do it yourself and bear that responsibility. You can use third-party software to do it. There are a lot of tax apps out there that do this now. I'd say with the tax apps and things like that, only do it yourself if you're very confident and you've got very simple tax affairs. Anything kind of more complex, a lot of them will only do your tax returns up to say £3,000 worth of income. So, a lot of them, I'd say, unless you're super confident, maybe take advice or use the Hmrc system. Don't use paper forms. They're a pain, and they're going to be extinct soon anyway. If you use paper forms, you have to submit them by the 31st of October every year, so you don't have as long. We should be submitting them kind of pre-July anyway, but your deadline is sooner for that, and they're going to be obsolete very soon anyway, so don't use paper forms if you can at all avoid it. Don't leave it too late. I've been banging on about this the whole presentation. Like I said, you can submit your tax return immediately. You haven't got to pay that tax until the deadline, but you'll have plenty of time knowing exactly what you're going to pay. If you can get your tax return submitted before July, after your first year of trading, if you've got any payments on account to make for the following year, you can adjust them. So if you've earned less one year than you have the other, that payment account still assumes you're going to earn the same as the previous year. Maybe you had a year where you didn't earn as much money. You can reduce your payment on account down, so you're not having to pay money over to Hmrc and then somehow claim it back. Always better to keep the money in your bank account if you can at all help it. It reduces your stress. And if you're using an accountant, the accountant's fees are lower the earlier in the year you go to them, because as people walk in the door in January and need the tax returns doing, we have the staff for that, and we have to put more people on or pay overtime, and it just gets more expensive to do. So the sooner the better. I think I've said that enough. And then in terms of what happens next, you pay your tax bill, you pay it online. You can pay it by debit card, you can't pay by credit card. You make your second payment account in January, you do that online as well. You can pay by check or at the post office, things like that, but online is by far the easiest way to do it. If you've earned under a certain amount of tax and you've submitted by a certain point in the year, they can, and you've got income that's collected, tax that's collected at source. So again, let's say maybe you're a landlord and you've got a job. If you don't make very much profit and you don't have an awful lot of tax to pay on that rental property, you can request that they just collect it for your tax code instead of you having to pay it over to them. But again, you have to get that in early. If you do it in January, you're just going to have to pay the bill. They probably won't let you do it through your tax code. You can check that your payment to them has been received using the HM Revenue and Customs online account. Everyone's got their own personal tax account. It's free to sign up for. You can check what you've paid. You can check your national insurance. You can check where you stand. It's a really handy little tool, super easy to set up with Hmrc. And if you are paying by post, include a letter and a stamped address envelope and ask for a receipt from Hmrc to know that it's been paid. They do, on occasion, accidentally allocate things wrong. If it does happen to you, it's very easy to sort out. The things you always need is your unique tax reference number. It's a 10-digit number. Always have that when you speak to them. But the more you can do online, the easier it is and the less likely things are to get lost or kind of lost in the system or allocated wrong. It does happen. If you think how many taxpayers there are, it occasionally things get allocated to the wrong place. Don't panic if it does. As long as you know you've done it right, it will sort itself out. Don't worry. I had a very scary letter from them a couple of years ago, which even me, I've been doing this a very long time, and it made me pause. I was like, oh, cripes, like, what is this? I knew I paid my tax bill. And they sent a letter basically telling me that the bailiffs were coming around. I rang them up and they're like, oh, no, sorry. Yeah, that was just a system error. Don't worry about it. There we are. Lovely. So don't panic. If you get a letter from them, don't panic. As long as you know you've done things right, you don't have anything to worry about. They're actually very helpful. They are just massively understaffed. So getting through to people on the phone can be difficult. If you can afford it or you can see the value in it, do get an accountant. They will not only make sure your tax is correct and save you money in terms of tax, making sure everything's allowable, they will also be able to deal with Hmrc for you as an agent, so you don't ever have to ring them. They'll just handle that for you. And that in and of itself is one reason to get an accountant, because it means you're not having to stress about that. You get a weird, scary letter, just send it to the accountant and let them handle it. They do it all day, every day. They love it. My team will kill me for saying that, but they do. They love it. It's what they do all day, every day. And in a nutshell, I've kind of rattled through that, really. I say rattled through, it's been 45 minutes. But that is tax returns. So I guess I'll kind of open the floor up now for any questions. If anybody wanted to ask questions, I'll do my best to answer them, as long as they're not too technical.
Thanks, Lucy. We've had some really lovely comments in the chat function just saying how helpful this session has been.
Oh, good.
We've got lots of questions to run through as well.
Excellent.
So let's get started. The first one is from Rosie, and she asks, if you do work in a pub or a cafe a lot of the time, are your food receipts tax deductible? Same for if you were having a meeting in a cafe and by the person you were meeting a coffee, is that tax deductible?
Right. So this goes about what's reasonable. So you would have to eat every day anyway. So if you made the decision to work in a cafe and you decided to have breakfast, lunch, and dinner there, and that costs significantly more than just eating at home or going home for breakfast, lunch, dinner, you'd probably struggle to argue that with Hmrc. But things that are kind of above and beyond or situational, or are there because it was impractical to take your own lunch. So classically, I might pop out for a meeting with somebody, we'd meet for lunch. You get very little argument about that going through. Booze, alcohol, you'll never get away with that, really. So keep that off the bill. But yeah, as it comes down to what's reasonable here. And as long as that meeting was not social and it was wholly exclusively, and that was the time you had to pick, and it happened to coincide with lunchtime, and therefore you had to do it, yeah, you're not going, that would go into travel and subsistence, and it's perfectly reasonable that you would do that, especially if your home working environment's not suitable for being able to hold meetings in. You don't have an office premises. Entertaining costs. So let's say that you're schmoozing somebody and you take them out for a fancy dinner in order to try and win their business. That's not allowable because that's entertaining, and only a small amount of staff entertaining is allowed. There are certain limits around that. But the kind of general, you're sort of feeding yourself in a fairly reasonable, plausible way, and you're not taking the mickey, yes, that would be absolutely fine.
Fantastic. Next question is from Joe. Is there anything in particular I need to do if I'm self-employed alongside a full-time job? I've started a side hustle, but still I'm working for full-time for now.
Cool. First off, congrats on the side hustle. Awesome. Love it. Yes, you need to register to submit a tax return to Hmrc. You need to do all the same things that anybody who is purely self-employed does. The difference is that you've obviously got other income. You'll need to remember, if you're making a profit on your side hustle, your tax-free allowance has already been used up in your tax code for employment. So every pound of profit you make will be taxed, unless you're basically will be taxed. I'm assuming here that you're earning over £12,500 in your main employment in your job. So every penny of profit on your side hustle will be taxable. So just remember that and save accordingly for that.
The next question is from Elena. She asked for bank interest. In my first year, I didn't have a separate business bank account set up. So do I need to include any interest I've received through my personal account I've used? I also use this account to pay for mortgage and bills, etc.
So interest receivable is always taxable, always. You'll find that most banks actually pay you that interest net. So you've already, there are very few banks that if you do, I mean, let's face it, unless you've got a lot in savings, you're not making very much bank interest paid here anyway. Yeah, bank interest receivable is always taxable. I mean, we're talking a couple of quid for most people, if I'm honest. I see thousands of tax returns a year. I've never seen more than about £100 on there because we work in small business. It's always taxable, but you'll probably find that your tax has already been deducted by your bank anyway. So you might get a bank statement and you'll see it's been grossed up. So you won't have to worry about paying any tax on it. Strictly speaking, it should go in your tax return. Although for the sake of a £1.89 or if it's very low, no one's going to care if you miss that off. It's not material. It's not a material thing to miss off the tax return, so it doesn't matter.
And the next question is from an anonymous attendee who asks, what happens if I opt out from the payment on account based on the belief that my income will be lower in the next financial year? However, at the end of that following year, it is the same income. Is there a penalty fee?
You'll pay interest on it. So you'll pay interest. You might not be penalised unless they think you're doing it. I've not seen, grand words here, I've not seen penalties imposed for deliberately for opting out of a payment account. But you always have to be aware that if Hmrc ever believe that you're deliberately defrauding them of tax or deliberately not paying tax to them, they do have the powers to impose penalties. However, what's more likely is that you're just going to have to pay interest on it at whatever their interest rate is that year. So the tax you should have paid, they'll calculate it when you do eventually pay it, they'll calculate it the interest back to the date that it should have been paid, and you'll need to pay that over. So that's if it's a genuine mistake, and it's just one of those things, and you'll have to deal with it.
Leanne asks, can directors of a company claim all or some of the costs mentioned in the presentation if they paid for it from their personal account and were not reimbursed by the company later? For example, a travel to a client meeting or a training course.
Okay, so this should, strictly speaking, go into your director's loan account because that expense was paid for, but it was incurred by the business, not by you personally. Even though you've paid it, the purpose of that expense was for the business. This is where the separation of a limited company and an individual can become quite messy. With a director's loan account, you are within your rights to charge interest on it if you choose. So the way to get around that, if you're feeling that you're pouring money into your limited company and that it's not benefiting you personally, you can charge interest on that director's loan account. You need to make sure that it's put in your M&As and that it's all spaced out legally. However, what you can't do is say, well, I've had my salary from my limited company and I paid tax. And again, what we're claiming this back from, I'm going to make a grand assumption here. If you're a director of a limited company and it's a small limited company, the likelihood is you're taking a combination of salary and dividends, or you're taking a very low salary and not paying a lot of tax on that anyway. Who are you claiming back that expense from? Because even if you were to reduce your by claiming this back, reduce your income to nothing, you only get back the tax that you've already paid. So you may not be paying any tax back personally. So I would move away from that. I would be tempted to look at the overall picture of yourself as a director of a limited company, how much money you're putting into that limited company. Bearing in mind that your director's loan account can cross tax years and you can take that money out of the company tax-free at some point in the future. If you're finding yourself constantly having to make payments on behalf of the limited company and you're not getting that money back, I would be wanting to look at some liquidity options and some cash flow options for the company to make sure that you personally are not kind of suffering for that. But that's a very tricky one. And to answer fully, I'd probably want some more details about the level of that, the salary and what we can do. But my advice is always to keep those things very separate because they are separate legal entities. And it's important to treat them as such. Where directors of limited companies use assets from the limited company for personal use, you could potentially incur a benefit in kind charge, like a P11D, which is very expensive, which you don't want to do. So I'd be very careful around some of that and definitely seek advice from an accountant who's seen the whole picture of what you're doing there.
Thanks, Lucy. The next one we've got in is from Victoria, who asked, my business won a £10,000 award on an accelerator scheme. Do I need to pay tax on that?
That depends on the conditions of the award. So some grants are taxable, some aren't, most are. So what will happen is if it's even competition prize money is quite often taxable, and it's taxable in the sense that it goes into your income, other income at the top of your profit and loss account, and just goes to you form as part of your income statement essentially. Most of them will be taxable, but not taxable in the sense that here's £10,000, please give me £2,000 tax. Taxable in the sense that they form part of your overall trading income.
We've had a question come in that was answered a little bit earlier on, but this person said they were a little late, so maybe worth just jumping back to it. They said, I saw the tax return deadline was extended. Is this true? And does this mean theoretically I can do my self-assessment in February without any problems?
Yes, and yes. In answer to that, yes, it's been extended. Yes, it's true. And yes, you can do your self-assessment in February. However, as stated, I don't love it. Get it done ASAP. It's not too much for a reprieve, and don't get used to it, because all you're doing is reducing the time between now and you're reducing the time between doing your tax returns. So it'll just creep up on you that much more quickly. But it's extended for a reason, because people have had rough years because of COVID. So if you need that extra time, yes, you've got until the end of February.
Fantastic. And the last question we've got says, will director's loan over £10,000 be taxed as income, even though it was paid back to the company?
Oh, so this is a very technical question here. The rules around director's loan, we're kind of moving off self-assessment a bit here, but the rules around director's loan is that if it's over £10,000 and it's not paid back within a reasonable period, which is usually within 9 months, then there is a potential tax charge on the company. I want to say it's an S43, 483, and potentially as an individual. So overdrawn director's loan accounts, don't love them, don't like them, definitely not over £10,000. Again, if you've got an overdrawn director's loan account, it basically means you're taking out more money from the company than your company can afford. So that's a wider conversation again about how you're being paid out of the company, how you're treating that. Of course, the implication for you personally is Hmrc could at some point decide, right, you can't keep kind of having overdrawn payback, even if the company's paying the tax charge. It's not good practice. Hmrc could at some point go, actually, this isn't an overdrawn direct loan account. This is salary. We're going to treat this like salary. Where is my tax? Please give me my tax for this salary that you've had that you've personally not paid any tax on. So we want to avoid that situation. Again, that's a much more technical question. Probably not appropriate to answer it fully here because I don't have all the details, but I would definitely seek advice on it. I would definitely speak to an accountant about that and look at the overall pattern and picture of your business and the relationship between you as a director and employee and shareholder and the cash flow of the company, and come up with a way to kind of solve that cycle if that's what you're in.
And we've had one more question sneak in, so we'll try and squeeze that in just before the end. How is self-assessment impacted if you haven't taken a salary?
Okay, so if you've not taken, so I'm assuming here you've got a limited company and you've not taken a salary from your limited company. You'd still, as a director of a limited company, have to do a tax return, but you just declare on there that I'm a director of a limited company and I've not taken any income from it. There's a little box to tick. If you're talking about being a sole trader and you're saying I've not taken any drawings, so I've had my sole trade business and I've not physically gone, here's my sole trader account, here's my personal account, I've not physically taken one from the other, it doesn't matter, it's not impacted at all, because as a sole trader, there's no legal separation between you as the proprietor of the business and your tax affairs. It's all one and the same. So you, as a sole trader, you're not taxed on your drawings, you're taxed on your net profits. As a director of a limited company, you're taxed on your salary, dividends, and you aforementioned director's loan shenanigans. That's where your income comes from. So yeah, depending on which one of those you mean, that would be the answer.
Lucy, thank you so much for the last hour and for sharing your expertise and knowledge. It's been really helpful for all the people on the webinar and watching it on the live stream as well. Excellent. I have included Lucy's LinkedIn profile in the comment section, so if you wish to get in touch with her, you can do through that. There will also be a follow-up email that will be in all of your inboxes very shortly, that will include an offer for using Mazuma. So thank you very much, Lucy.
You're very welcome, and happy New Year to everybody, and have a fantastic time running your businesses.